Well, thank you very much. I think very much we feel almost the odd man out in these presentations, given the focus on resources. And I think, as has been said, part of the reason for the explosion and interest and the success of our resource companies gives me confidence in the fact that there is great opportunity in the Australian property market. I think we are seeing all of the fundamentals in the Australian property market coming into line to give potential for recovery in capital values in the years to come. Now, if I could just take you to perhaps the background, the history of Cromwell, because I think that will give you an indication of our philosophy, where we're positioned and the opportunities we have for the future. We started our business in 1999 with an initial capital contribution of $700,000 in cash, and at present we have a market capitalisation of about $700 million. The philosophy of the business has been to manage property for the benefit of investors with an internally managed model. We do everything from facilities management, property management, treasury management, asset management. It's a fully integrated model, and as a result of that I think we can deliver some pretty tangible benefits to investors because we control our tenants, we control our buildings, and we've got a very good understanding of what's required to deliver value and maintain value. We've presently got on balance sheet about $1.4 billion in assets, and we externally manage about $400 million worth of assets. We're firm believers in the fact that in having an internally managed model, you have the opportunity to leverage that management and those resources to provide additional returns to your shareholders. We started our business in the retail funds management area. We promoted syndicates, small trusts, to mum and dad investors. And there's still very much a core part of our business today. We're one of the very few remaining retail funds management operations in Australia. There was a flight of retail wealth into property vehicles in the period from 2000 to 2007. That capital wasn't managed well on average. We saw a number of players put together vehicles that were simply designed for the benefit of the managers. And I think it's a common thread. You've seen that in the United States as well. Basically, funds are run generally for the benefit of the managers rather than the investors. Our philosophy has always been to look after the investors first. That's the basis on which your business has to be built, and it's a recipe for success in the future. That concentration on retail investors has been both our strength and our weakness. It's a strength because our retail investors are very sticky. They support us. A recent survey that we undertook of our shareholders, who comprise our original retail investors, showed that less than 4% of our investors considered selling their stock in the next 12 months. The downside of that is that our liquidity isn't as strong as it should be. We have a register that's very significantly represented by our original retail investors. For approximately 7 years, we built our retail business. We took all of our funds and stapled them together in about the end of 2006. Unlike a lot of our peers, we saw that the market was becoming fairly full. We didn't foresee the exact magnitude of the global financial crisis, but we knew there were clouds on the horizon. As a result of that, having stapled all of our funds together with our management business, we took the opportunity to reduce our debt. So that at the peak of the property market, immediately before the GFC, our gearing was at 35%, which was pretty much one of the lowest leverage levels in the Australian property market. That then gave us the opportunity and positioned us for growth through the downturn. And so since that time, we've bought strongly in what has been a fairly poor market. For a number of years, the largest commercial transactions in Australia were undertaken by Cromwell. And as a result of that, we've seen quite a significant change in the structure of our business. We've taken a view that you have low gearing at the top of the market and increase your gearing at the bottom of the market to take advantage of leverage. Now, that seems to have been a novel concept with a lot of our peers and a lot of people in the property industry generally. But similarly, you buy low and sell high. And again, that's a concept that has been abandoned by a lot of managers, principally because their businesses have been run for themselves. They get fees by buying, particularly at times in the market when prices are high. Where we sit at the moment is that we're well placed to take advantage of opportunities that exist in the market in a growing economy, driven in part by the commodities boom, but also in an economy that's fundamentally sound. We have a very strong management team that has been together for a number of years. They're all property professionals. And again, I think what makes us a little bit different from the average funds manager is that we take people from a core skill, property management, asset management, rather than simply import people who are good financially and try and adapt them to a different asset class. That means our people have very, very good and close understanding of what it takes to make a property investment successful. And as I've said earlier, we're not afraid to sell property if we think it's the right time or if we can take a profit. In terms of our financial performance, I think one of the very few REITs in the world that have an NTA now in excess of our NTA at the peak of the market in 2007. We're one of the very few REITs in the world that hasn't undertaken a dilutionary capital raising. All of the capital that we've raised has been raised at or better than NTA and applied accretively to acquire assets that will provide us with strong returns in the future. We're currently trading at about a 9.2% yield. Now, that's on a very secure asset base with very strong recurring income. It's a very attractive yield, and it's a yield that has attracted support from investors from South Africa, the US, Asia. Again, our single biggest issue is the fact that we don't have enough stock outside our retail investors. And in the last few years, we have taken opportunities to raise capital and increase our institutional shareholding proportion. We look to continue to do that to take advantage of the opportunities that exist in the market. In terms of our debt profile, we've been scrupulous in maintaining a forward review of our debt profile. We've just again rolled it for a further 3-year period. We're on excellent terms with all of the major Australian banks. We're seen as a very good prospect and a very good customer by all the Australian banks. We have no difficulty borrowing. We have no difficulty maintaining our debt. The statistics of which I'm most proud are our performance across the cycle. We've consistently, over a short, medium and long term, outperformed the 300 AREIT index. We've consistently outperformed in terms of our property management, and we have the best performed property securities fund in Australia. We're able to do this because of our focus on our investors and because of the fact that we're prepared to make decisions and think independently rather than move with the herd. The Australian property market at the moment, and this is a generalisation given that there are a range of sectors and a range of individual geographic markets, has generally bottomed and is showing strong signs of recovery. Now, it's difficult to talk of a market as a single market. What we'd say is that the value of core properties has bottomed. We think there is still a fair degree of movement to occur in secondary assets and development assets. Simply put, we don't believe there's an appropriate risk-return margin between the better assets and the secondary assets. What we're seeing in Australia is strong offshore and institutional demand for assets at the core end of the spectrum, assets that provide long-term secure returns. And we're seeing that the yields for good core Australian assets are regarded as attractive by international investors, and that the yields that they generate are attractive by world terms. What we're seeing as a consequence of the growth of China, the commodities boom and a strong economy is rental growth in most of our major markets, and we're seeing that the compression of cap rates is starting to re-emerge after some years of softening in cap rates. We see the better opportunities in the market in the office sector, and whilst we're sector agnostic, we're strong believers in putting our investors' money into the sectors and markets that provide the better returns, and in this case, for the short to medium term, we see that in the office market. We've been generally unwilling to put our investors' funds into retail because of the concentration of ownership issues that occurred in Australia. And we saw the race to the bottom that occurred in the retail market in the 2000s lead to the failure of several retail groups, including Centro. There was an attitude in Australia that retail yields would compress forever. We didn't simply see value in the retail market, and we take a view that to manage a retail portfolio effectively, you need a very good retail platform. We are interested in the sector if the price is right. Our portfolio is comprised mainly of attractive office assets in the better markets in Australia. We have a weighted average lease expiry of 6 years as a result of a deal that I'll come to in a minute. That will increase to about 8 years. That's pretty much the best weighted average lease expiry profile in the REIT market, and I'd stand that up against any lease expiry profile of any REIT in the world. Our concentration is in key office markets in Sydney, Melbourne and Canberra. Office represents more than 90% of the portfolio. In a minute I'll come to some statistics on how our portfolio has improved in quality, and again that's another matter of which I'm very proud. Our top 5 assets represent more than 50% of our portfolio, with an occupancy of 99.3% and a weighted average lease profile of 7 years. It's an indication of the strength of our management team that we have one of the highest tenancy retention rates of any property organisation in Australia. Similarly, the quality of our income stream is high. 79% of our gross income is leased to government or ASX 200 listed companies. If we take into account leading listed companies across the world, 89% of our income comes from the government or leading listed companies. 75% of our portfolio is subject to fixed or minimum reviews, with an average minimum increase next financial year of 3.9%. Our target consistently is to achieve 4% or better annual growth in like-for-like net property income. Our lease profile is very strong. More than 57% of our lease income is maintained and maintainable until after financial year 2017. We have minimal expiries for the next 3 years, and again that's a factor of the good work that our management team has been able to achieve in the market in terms of securing tenant retentions. It's also an indication of the strengthening in Australian office markets generally. As I indicated earlier, one of the things of which I'm most proud is the fact that during the downturn downturn, we have managed to significantly improve the quality of the portfolio. Whilst others have sold assets or have undertaken dilutive capital raisings, we've raised capital to buy quality assets. That's led to considerable improvement in our portfolio quality. Our average asset value has increased, the percentage of government listed tenants has increased, the percentage of our exposure to the office markets where we see most growth has increased. Effectively, we've bought more than $400 million worth of assets. We've syndicated assets to a value of more than $170 million. We've sold $55 million worth of assets. Our portfolio is now in excellent shape and stands amongst one of the best in Australia. I'd just like to give you an indication of some of the transactions that we've undertaken in recent years, and I think it provides an interesting insight into our capabilities and strengths. 321 Exhibition Street, Melbourne, was a property that we acquired at a time when confidence was low in the Australian market. Our investment strategy is built very much on a bottom-up fundamentals approach. We saw a very strong prospect of rental uplift in Melbourne. We saw very limited demand. We saw good absorption rates. We acquired a building that at the time was empty and have undertaken a significant refurbishment of the property and leased 100% of the building to one of Australia's leading energy companies. The property has been leased for a 10-year term and provides annual uplift in rental of 4% or CPI, whichever is the higher. Presently, our NTA figures don't include any uplift in value for this asset, but we're very confident that come 30 June this year, when the refurbishment is complete and the lease commences, that we'll see good uplift in value. Again, another asset that indicates our capabilities in the refurbishment and releasing area is a distribution centre that we own in Victoria. We've just refurbished the building and entered into a new 10-year lease with the Woolworths Lowe's joint venture for its use as a distribution centre. Again, uplift in capital value will be recognised for this asset come 30 June. We bought what was then one of the buildings occupied by Qantas in Sydney in the middle of last year. Since that time, we've negotiated with Qantas a significant refurbishment of the building, an extension of their lease to 22 years, taking our weighted average lease expiry across the portfolio to nearly 8 years. We've negotiated fixed reviews for the facility for 22 years. The building will provide us with a substantial income stream over the next 22 years and considerable uplift in the value of our assets. If I can talk for a minute on some significant tax advantages that have been introduced by our government in recent years that make investment in Australian property very attractive. Our structure is as a stapled entity, which means we have both a trust and a company that are joined together and trade as a single entity on the ASX. Those two entities have different taxation treatments. The trust pays distributions from its income, the company pays dividends. The distributions that come from the trust are taxed at a rate of 7.5% as a final tax on taxable distributions. Because of the operation of our investment allowances and depreciation rates, a significant proportion of the income that's distributed from a trust is not subject to taxation because the taxes are paid in the hands of the unit holders rather than at the entity level. The unit holders get the benefit effectively of those investment allowances and depreciation entitlements. So a substantial proportion of distributions are subject to no immediate tax. Those that are taxable are subject to a final rate of 7.5%. There's no capital gains tax for holdings of less than 10%. What this means is that it's extraordinarily attractive for offshore investors, particularly pension funds, to invest in Australian managed investment trusts. The effective rate of tax on these investments ranks amongst the best in the world. And given the high yields that are payable on these assets, these sort of investments have proved extraordinarily popular with pension funds from Asia and elsewhere who seek to match the long-term recurring income at an attractive premium with their forward cash flow requirements. I have some information in the appendices to the presentation that I've circulated, but if I can just provide you with an overview and summary of Cromwell. We've got a very, very strong recurring property earnings base. We've got a very long weighted average lease profile providing security. Currently 6 years. On the commencement of the Qantas lease, that will be nearly 8 years. We've got minimal lease expiries in the course of the next 5 years. Annual growth in property income is expected to be or close to 4% per annum. We've got an existing yield on our securities of 9.2% based on our current security price. We've got a very simple balance sheet. Our earnings are not dependent on undertaking additional risk or on development exposure. We've got the opportunity with our funds management business to provide growth to those earnings over and above movements in our rental income. We've continued to expand our assets under management over the last 3 years and will continue to benefit from improving valuations, particularly given the gearing level that we've achieved in the last 3 years. A 10% growth in valuations will translate to a 20% growth in NTA per security. We've got the ability to leverage our skills over a much larger asset base, and we'll continue to implement the philosophy that we have of putting our security holders and our investors first and maintaining our disciplined approach to transactional activity. What we see going forward is a potential for growth, further growth in our security price as market rentals improve. And we see, particularly in the Melbourne market, strong uplift in market rentals and an expected growth in rentals in the Sydney market in years to come. I've set out in the appendices details of our property portfolio. As I've indicated, they are in the main quality A-grade office buildings with substantial and/or government tenants. Our top 20 tenants are governments or leading ASX listed companies. We have a strong focus on sustainability and efficiency in our buildings. Our neighbours' ratings are pretty much bang on 4-star across the portfolio, giving us one of the best ratings of any portfolio in Australia. We've given some details on our individual properties in the appendices, and I'd invite you to look at those at your leisure. Again, I think in summary, I'm able to present to you what I think is a portfolio and an entity that has a very, very strong recurring income stream at an attractive yield. As I say, the challenge for us is to improve the level of institutional investment and to continue to attract additional investors based on the strengths, qualities that we have in the portfolio. Happy to take any questions